Rob is a director with BlackRock. BlackRock, for those of you who may not have heard that name, they're one of the largest investment management firms in the world. They manage about $4 trillion, a big number. And they do that through a variety of different investment strategies, products, everything from exchange-traded funds, mutual funds, etc. So very, very large company. Rob's has had a 25-year career, first starting off in the investment industry with a large brokerage firm, most recently, however, the last 5 years with BlackRock. And he has been giving workshops like this around the country for the last 5 years. Rob came from New Jersey this morning. I guess traffic was light. It's a long drive, but I really appreciate you starting early. Also, welcome home. Rob's a CU graduate. So for the Buffs, that's good. For the Rams, you know, a little booing here. So at the end of today's workshop, what we hope you walk away from today's investment, today's time investment you're making, is that you have better clarity about Social Security and your choices, that you have more confidence about what choices to make, and that it increases your capability. It helps you to understand what those cash flows might look like for you in your particular situation. We, as advisors, also have a tool, thanks to BlackRock, available to us to do some hypotheticals and answer some questions that are very specific to you. So with that, welcome Rob, and really appreciate Golden Drive this morning.
Absolutely. Thank you. Yeah, it was a brief 30 hours. Because I've actually done that drive before when I moved out to New Jersey from Colorado. All right, so we're still good morning, everyone. Got 15 minutes more left of that. Wow, Social Security. Clearly you guys didn't have anything better to do for lunch. As Steve said, the goal here is to try and help you understand something that, I'm going to go out on a limb here, that most of you probably don't understand. And the reason would be that all of us bought our Social Security in complete and total ignorance. Think back to your first job. Other than the deduction on your paycheck, what other information did you get? Show of hands of people who got a buyer's guide or a user's manual. Those don't exist, do they? It wasn't until October of 1999 that they started to send us a statement in the mail every year trying to summarize what it is we've been buying. But that statement is very narrowly focused. It only talks about the money that you've paid into the system and the benefits that can be derived from those payments. It doesn't talk at all about money you might be able to collect off of somebody else's earning history. It doesn't talk about options you have for redeeming that benefit other than waiting. It does cover that. But there are a lot of other options it doesn't cover. And then probably most importantly, it doesn't discuss strategies at all. Ways you could maximize the amount of money you're going to get back. And so my goal today, as Steve alluded, is to try and make you more informed consumers about a purchase you've been making your entire working life. So why don't we dive in? I'm going to start with some statistics. These statistics basically conclude that we're all living longer. There are some purple bars at the bottom that basically point out that for a couple that reaches the age of 65, there is a 25% chance that one of you are going to live into your late 90s, and a 50% chance that one of you will live into your early 90s. Now allow me to contrast the fact that we're all living longer with this statistic. 74% of all the people collecting a Social Security retirement benefit today are collecting a reduced benefit. Meaning they took their money early, well maybe because they didn't believe these longevity assumptions apply to them. Actually, if it was that simple, if this was just a longevity decision, my presentation would be all about 4 minutes. But it's not! No, you got me for like 45 minutes worth of stuff. And then questions. Why is that? Well, because this thing's kind of complicated. I mean, the government's had a long time to work on this program. They worked on it. I actually like to start my discussion about the program itself with that statement. Now, for those of you on the phone, you won't be able to participate in this particular question, but I'm asking everyone in the room to please raise your hand if you got a statement this year in the mail. All right, now I'd like everybody in the room, keep your hands up. I'd like everybody in the room to look at everyone who has their hand up. These are people you should not trust. They didn't get a statement in the mail this year. They thought they did, but they didn't. Social Security's been a little schizophrenic about the whole statement thing over the last 2 years. 2 years ago, they decided, you know what, let's save about $70 million and stop sending them out. So they did. And then some people complained. So last year, starting February 15th, they started mailing them out, but only if you were over the age of 60. And then May of last year, they put them online. Anybody sign up for their statement online yet? Oh, good for all of you. Excellent. Because of that, November of last year, they announced, now that they're online, we're done with them. Right? We're not gonna mail them out anymore. Anybody see the Super Bowl commercial they took out announcing that? Yeah, no, they didn't. Right? There was no announcement, right? It was kind of just they stopped. So it's kind of out of sight, out of mind, right? You think you might have gotten one, but you really didn't, and they're not coming anymore. So it's really important, though, that you review this statement every year, because on page 3 of the statement is a section entitled Your Earnings Record. Right? This is a history of every dollar you have ever paid into that system since the dawn of time. Or at least it's supposed to be. Right? I think everyone's aware the government makes the occasional mistake. This form is not immune from those mistakes. So you're going to want to review the middle column to see if there's some zeros in years you know you were gainfully employed and paying into that system. Because it's the best 35 years on that list that's going to determine how much money you get when you ultimately go to collect your benefit. And so if you've got zeros there that don't belong, you're going to get less money than you're entitled to. Now there's a phone number on the bottom of page 3 you can call to correct an error you find. It is highly likely they will require a W-2 and or a tax return from the year you got ripped off. So obviously the sooner you get after this, the more likely you are to dig up that paperwork. And then I do need to point out that officially, you only have 3 years, 3 months, and 15 days to correct an error. Aren't you glad they gave us the extra 15 days? But they also have a lot of exceptions to that rule. So if you do find an error going farther back than that time frame, you should try and get it fixed because there's a high likelihood you'll be one of the exceptions. Now on page 2 of that statement, you'll find estimates of what you might get at 62, full retirement age, and 70. And you need to point out they are just estimates. They're based upon an assumption that you're going to keep working until each of those ages, earning whatever you did last year. So if you're not planning to work till 70, you might want to set your expectations that that age 70 estimate might be a little higher than what you'll really get. And then as I mentioned, they're not sending them to you in the mail anymore, so you got to go out to their website and sign up. All right? Once you've signed up, you will get an email every year reminding you that you should go out and take a look at your statement. All right, so that piece of advice is good for everybody. Anybody who's paying into this system ought to do this. The rest of this presentation is geared towards people who are approaching that decision point. Should I take it early or should I wait? Fundamentally, you've got to decide. Do I want to reduce benefit and I'll take it early? Shall I wait till my full retirement age and get my full benefit, which Social Security has conveniently named your primary insurance amount? Now that's just a big fancy phrase they invented to describe the amount of money you're eligible for at your full retirement age. But it's a pretty important number because there are a lot of other calculations that are based off of your primary insurance amount. And then, of course, if you wait past that age, up until 70, you get a raise. They call that a delayed retirement credit. Now I do need to point out that that full retirement age is actually a variable. Back in the early 80s, Congress was taking a look at the system and they came to the conclusion, whoa, this thing's going to run out of money. We need to do something. So they actually made a lot of changes then. One of the more significant changes was moving the full retirement age out. It used to be 65 for everybody. Now, depending on when you were born, it's between 65 and 67. As I look out at this illustrious audience, I notice we have at least one baby boomer among us. For that first wave of boomers, born between 1943 and 1954, you have a full retirement age of 66. Now, if you decide to take your benefit 4 years early at age 62, please be aware that you will be signing up for a 25% permanently lowered check for the rest of your life. Now again, for every month you take it early, they ding you a little bit. And what I'm summarizing is how big those reductions are on an annual basis. But wow, 25% hit. That's a pretty big reduction. Why would anybody sign up for a 25% lower check? Well, there's a whole host of reasons. 74% of all the people getting a check have a reason why they took it early. The most common reason is because they need the money. They don't have a choice. They need it in order to pay the bills. So I don't have a whole lot of advice for that audience. But for people who are struggling with, should I take it early or should I wait, we're basically going to talk about 3 things today that you should be factoring into that equation. Clearly, longevity is something you need to think about. The system is structured to give you more money if you wait, and the only way that pays off is if you live long enough for that higher benefit to make sense. So that absolutely is a consideration, and we'll talk more about that as the day goes on. This is, in my opinion, whether you're married or not, or have been married, is probably the most important factor in determining when you should take your benefits. And that is where I'm going to spend most of my time today. But right now, I actually want to spend a little bit of time talking about working or the lack thereof. If you decide to take your money early and continue to work, you're going to discover that Social Security is not a big fan of that. It's supposed to be a retirement benefit, and so as such, they put a penalty system in place to discourage people from taking the money early and continuing to work. Here's how the test works, or the penalty system. They will apply a work-related earnings test to you if you try to collect your money early. Now, when I say work-related earnings, I'm talking about W-2 income, self-employment income, that kind of stuff. I'm not talking about dividends and interest and long-term capital gains. But if your work-related income exceeds $15,120 this year, that number will go up next year, it goes up every year. For every $2 above that threshold, Social Security is going to keep $1 of your Social Security check. So it doesn't take a whole lot of earnings for part or all of that check not to show up. And if you're going to sign up for a permanently lower check and then not get it, well, that might not be such a great idea. And I'd like to also point out, however, that the government didn't think that that particular rule was complicated enough for all of us. So they decided the year you reach your full retirement age, you needed a new test. You can actually earn $40,080 that year, and then they're only going to keep $1 for every $3 above that threshold. Now, the last thing I'm going to point out is that once you reach the month of your full retirement age, this test goes away. All right? So at that point, whenever you're celebrating the month of your full retirement age, you can begin to collect your Social Security, earn all the money you possibly can, and not have to worry about any of your checks being withheld. Now, what if you make a mistake, though? What if you take your money early, and then you go back to work, and suddenly all your checks are being withheld? And you're like, well, this is horrible. Can I fix this? And the answer to that question is... yes. Maybe! It used to be yes, it's been downgraded to maybe. So, as the government often does when it identifies problems, it creates forms to fix those problems. And in this case, they created the request for the withdrawal of application. You need to fill out this form. You need to send them a check for every dollar they've sent you since you began collecting benefits. There are no penalties, and there's no interest due. And if they accept your form, it's as if you had never filed in the first place. It's kind of like the ultimate do-over button for Social Security. But here's why the answer is maybe. In December of 2010, they announced that if you've been receiving checks for more than a year, they will deny your application. At that point, your decision has become irrevocable. So you've got a 1-year window to decide you've made a mistake, and then once that's passed, you're stuck with whatever decision you've made. All right? So that's the downside of collecting early. Lower check, and you've got this withholdings test to deal with if you're still working and below your full retirement age. Let's talk about the upside of waiting. The upside of waiting is the raise I mentioned, the delayed retirement credits. You get one for every month that you wait. It equates to an 8% annual increase. So if you wait from 66 to 70, now you're looking at a 32% permanently larger benefit. So how do you decide? 32% permanent increase, 25% permanent reduction, and every single option in between. Well, if you are single and you've never been married, it's actually not that complicated. All you need to do is decide how long you're going to live. You decide that you're going to live into your 80s, you should probably wait till 70. You're not so sure you can put up with the rest of us for that long, you should probably take it earlier. But if you're married, or you have been married, this becomes a lot more complicated. And that's because there's 2 additional benefits that you're entitled to that single people who have never been married are not entitled to. And these are called spousal and survivor benefits. And while they're mentioned on that statement you used to get in the mail, they're pretty poorly described. And I would venture to guess that most people really don't appreciate how powerful these things are and how important they should be considered in your ultimate collection decision. So I'd like to actually spend a little bit of time explaining them to you. All right, and to do that, I'm going to start with the spousal benefit. Spousal benefits are benefits that are available when both people are still alive. When one of them passes away, we'll be talking about the next benefit, which is a survivor benefit. But we're going to stick with the living right now. To walk through this example of how spousal benefits work, I'm going to use a hypothetical couple. So we've got John and Jane. I've given John a $2,200 primary insurance amount, which means when he turns his full retirement age of 66, he can collect $2,200 a month. And in this example, I've given Jane a primary insurance amount of $0, which means based upon her work history, she didn't qualify for a benefit, so she didn't pay into the full 10 years, so she can't collect anything off her own earnings history. Now, if you'd like to switch the genders, feel free. Social Security is gender agnostic, but I'm going to go with this couple for my example. So the first thing everybody should know about spousal benefits is this. Any spouse is entitled to 50% of their partner's primary insurance amount once they themselves reach their full retirement age. So, as it relates to this couple, what I just said was, because John has a primary insurance amount of $2,200, when Jane reaches her full retirement age of 66, the spousal benefit is equal to half of that, or $1,100. Now I need to emphasize, at age 66, John could get a check for $2,200, and Jane could get a separate check for $1,100. They don't impact one another. All right, so that's point number one. Point number two, Jane actually isn't eligible for any of that money until John at least files for his benefit if he isn't already collecting that benefit. Now you notice I use the term file and collect as if they were two different things. And that's because they are. Something you didn't read about on your statement was the fact that once you reach your full retirement age, you get some new options that you didn't have prior to your full retirement age. And one of those options is the ability to do something known as filing and suspending or filing and deferring. It's the same concept. If you call up Social Security prior to your full retirement age and file for a benefit, you only have one option at that point, and that is to collect your benefit. If, however, you wait till your full retirement age to file for your benefit, you get a new option. And that option is to tell Social Security, actually, I don't want the checks yet. I'd like to keep earning the raise every month, and I'll call you back later and collect the bigger check. Well, so why would anyone want to do that? Well, because as soon as John files for his benefit and Jane turns 66, she gets to collect the $1,100, even if John's not getting a check yet. If John's waiting till 70 and he doesn't call up till 70, well, Jane's got to wait till 70. So, kind of an important item with regards to making a spouse eligible to collect that spousal benefit. Another important thing or option you gain. If John waits until his full retirement age to file for his benefit, up until the age of 70, he has the ability to change his mind. So if John at the age of 69 suddenly wishes he had taken the money at 66, he can call up Social Security and say, hey, you know all those checks I've been deferring for the last 3 years? Yeah, I need them all. Could you please send them to me? And they will. They'll send him one lump sum for all that money he's been deferring. Now, he'll lose all the raises he would have built up at that point and lock in the $2,200 a month going forward. But if he needs the money, he can get at it. And this applies to single people who've never been married, by the way. If you're thinking of waiting until 70, you should file and suspend so that if God forbid something horrible happens between 66 and full retirement age, you have the option to go get that lump sum. If you don't file and suspend, and you call up at age 69 requesting help, the only thing they're going to be able to do is turn on your monthly check. So there are a couple of options there you need to be aware of. The most important for what I'm talking about now, the spousal benefit, it is the key to making your spouse eligible for the money. So it's 50% of the other person's primary insurance amount, but you can't have any of it until that other person at least files. All right, last thing I need to explain. The amount of money that Jane receives from this benefit has everything to do with when she collects it and nothing to do with when John collects his benefit. Eligibility is all about when John files. But the amount has nothing to do with that. If John takes his money early and locks in a permanently lower benefit, as long as Jane waits till 66, she gets the $1,100. John waits till 70 and locks in a much larger benefit. Doesn't matter. At age 66, Jane is still only getting $1,100 because it is 50% of his primary insurance amount. It is not 50% of whatever check he is receiving. So at age 66, Jane gets the full $1,100. If she's eligible for the money earlier and collects it, it gets reduced. This, by the way, that's a universal truth about Social Security. Any money you take early, your own, a spousal, a survivor benefit, anyone that you collect early is going to be reduced. And if you're working, subject to that withholdings test. But the reduction factor they apply to spousal benefits is the largest of all the reduction factors. You're taking a 30% haircut at age 62 versus your own benefit, it was a 25% haircut. So they really try to discourage you from taking this one early. And here's the most important thing I want you to pay attention to. If Jane doesn't need the money at age 66 and she's willing to wait, guess what happens? Nothing! So if you become eligible for one of these things, please don't wait past your full retirement age to collect it. Because for every month you wait, that's just money you're leaving on the table and never getting back. All right, so that's spousal benefits. Let's talk about survivor benefits. Fundamentally with survivor benefits, this pie chart is basically just summarizing that as of 2011, the last time we were able to get aggregate statistics out of Social Security, they basically told us that more than half of all the women collecting a benefit today are collecting part or all of their benefit based upon their husband's earning history and a decision he made about that earnings history. So the key thing to understand about survivor benefits, and just real quickly, right? Spousal benefits were eligible when both people were still alive. When one of them passes away, the surviving spouse can select or can collect a survivor benefit. Okay, now it will be in place of any other benefit. It's kind of, Social Security does not let you double up on benefits, right? It's kind of whatever the bigger one is, you can take. And you could choose to take the lower one if you wanted in some instances, but you can only take one benefit at a time, essentially. All right? The survivor benefit is calculated in completely the opposite way from that spousal benefit. Remember how I said there was no relationship to what John does with his benefit from a dollar amount standpoint? Well, with the survivor benefit, if John decides to take his money early and lock in a permanently lower benefit for himself, when he passes away, Jane also now has a permanently lower survivor benefit available to her. If John, however, waited till 70 and locked in a maximum benefit for himself and passes away, Jane is now eligible to collect that maximum benefit for the rest of her life. So here's what I want to emphasize. If you are the higher earner in a married couple, please don't make the mistake of just looking at your life expectancy when it comes to making your collection decision. It's a very common thought process to think, wow, I've got a really bad family health history. I paid a ton of money into this system. I'm taking it at 62, so I at least get something. Well, the flaw in that logic is you're ignoring the survivor benefit. Because the question really should be, what's the likelihood one of us lives for a while, not just me? Everybody remember at the beginning how I pointed out there was a 50% chance one of these two people was living into their 90s? And it's probably Jane. Sorry guys, we got the bad chromosomes in the deal. Does she want to be living on 1833 or 2904? So please, if you are the higher earner, make sure you understand how the survivor benefit is calculated because it's not covered on the statement anywhere. All right, so thank you everyone for staying awake for the boring part. Right, we've covered the statement, work-related earnings test, spousal survivor benefits, but you're all still sitting there going, when's he going to tell me when to take my money? All right, so that's going to be this part of the presentation. We're going to talk about some collection strategies now. Now, as was mentioned earlier at the beginning, BlackRock does make a calculator available to all the financial advisors in this room to use on your behalf if you're so inclined. We built that calculator about 5.5 years ago. We filed for a patent then, so in another 2 or 3 years, I'll let you know whether we get it. Oh, I see some of you are familiar with patent. The purpose behind the calculator was to help married couples not only understand their decision, but make the best possible decision for their unique circumstance. Because when you have potentially 2 individual benefits, a spousal benefit, and a survivor benefit to consider. How do you make sense of all of that? So that's what this calculator tries to do. So what I want to do now is just kind of walk you through how this calculator might work for John and Jane. Now, if at the end of this you're like, wow, I'd really like to have one of those run for my situation, you will need to bring one of the advisors in this room some information. It's quite a bit of information, so be prepared. You'll need to bring them a primary insurance amount for each person. Right? So you have to go out onto the website and get that number. All right, that's pretty much it. And then you will need to talk life expectancy assumptions with them as well. Right? So it isn't a whole lot of data. It's actually very little. The reason you need to talk life expectancy assumptions is because it does matter when you take the money and how long you live as to how much you're ultimately going to get. What I actually encourage everyone to think about, though, is when you use this calculator, why don't you start by looking at what a lack of longevity might mean for you and your spouse, and then look at one where you have some longevity, so you try and understand the trade-offs at the 2 extremes, because I've yet to meet the person who can actually pick that midpoint accurately, right? You don't know the answer to that question. So let's try and look at what the 2 extremes are to understand the trade-offs to hopefully make a decision that works well in both scenarios, right? So let me show you what I'm talking about. Here we are with John and Jane. I'm going to start with a lack of longevity scenario. I've got John living through 75 and Jane living through 82. Well below the life expectancy of a couple that's made it into their 60s. And we're going to start by looking at how much money would this couple get if they both took their checks right away. Now you'll notice from my example, I bumped up Jane's primary insurance amount from $0 to $600. That way we have 2 individual benefits, a spousal and a survivor. We've got all these benefits to think about. So if John takes his money right away at 62, he's not getting $2,200 a month. He's getting a 25% lower benefit. So he gets $1,650 a month, and he'll get that check for 168 months, from age 62 through age 75. Now Jane's $600, it gets reduced by 25%, so she gets a check for $450 for that same time frame, by the way. Because $450 is a heck of a lot smaller than the survivor benefit. So when he passes away, she's going to stop collecting her benefit and switch over to that survivor benefit. And because John has already filed, she is eligible for a spousal benefit as well. Now because the spousal benefit is larger than her own benefit, there's some extra money available for her from that spousal benefit. The way Social Security keeps track of it is they look at what spousal benefit would you be able to collect at your full retirement age. So for Jane, it's $1,100. What benefit could you collect off your own earnings history at full retirement age? In that case, it's $600. The difference, which is $500, is the pot of money that she could collect in the form of a spousal benefit. Now, because she's taking it early, it's going to be reduced by 30%. So that $500 reduced by 30% is $350. So starting at age 62, Jane gets a check for $800 a month. It's in between a 25% reduction and a 30% reduction of that $1,100. And the reason is because of the way they keep track of these things. I told you, they've been working on this thing for a while. This is one of the areas where they really tried to make it complicated. To simplify all of it, just think of it this way. They're going to give you the larger of the 2, and it's going to be reduced, maybe with a little extra complexity. But if you just think about you're getting a larger number and being reduced, that'll get you close enough. All right, so in this case, she's getting $800 a month. Then, when John passes away, she collects the survivor benefit for another 84 months, so that in total, this couple gets $564,000 out of Social Security, even when they didn't live very long. Steve threw out that number of 380 or something for the average individual. I mean, here's a couple with a lack of longevity that's getting $564,000 out of the system. Who here had any idea you could get more than $500,000 out of this system, even if you didn't live very long? I mean, it's one of the things that surprised me when we did this. But that's not what I want you to focus on. What I want you to focus on is how that number changes as their collection strategy changes, right? So 564, if they take it right away, how much do they get if they wait? So now we're going to look at waiting 4 years to their full retirement age. So no checks for 4 years, but then bigger checks when they start. John gets the full $2,200. Jane gets the full $1,100. And then when John passes away, Jane gets a $2,200 survivor benefit. And even though they didn't live very long, they still got more money by waiting those 4 years than by taking it right away at 62. They get about $581,000. So what happens if they wait till 70? All right. Now we have no checks for 8 years. But then the checks are huge, right? He's getting $2,904. She's still only getting $1,100 because of the way that spousal benefit works. Remember I told you don't wait on that one? But then when he passes away, $2,904 is a survivor benefit. And guess what? That was a horrible decision for them. That's $532. That's the smallest number up there. And that's why some people aren't going to want to wait till 70. Because if you both don't live long enough, bad outcome. You just ended up leaving more money to your least favorite beneficiary, Uncle Sam. And nobody likes to leave money to him. But now what if I could show you a hybrid strategy where we combine collection decisions to try and maximize the amount of money we get back? So let me show you one for a couple like John and Jane where there is a large discrepancy in earnings histories. In this case, we're going to look at having, God bless you, we're going to look at having Jane take her money right away, the lower earner. Having the higher earner file and suspend at full retirement age, allowing Jane to now take an unreduced spousal benefit starting at 66. So her piece of the pie got reduced by 25% because she started with it earlier. But because she didn't become a bit eligible for the spousal piece until 66, that piece of it doesn't get reduced. She gets the full $500. So starting at age 66, she gets a check for $950. We then have the higher earner take their money at 70, locking in the largest possible benefit for him, and the largest possible survivor benefit for her. And that particular strategy gets them the most money, about $589. Now, you may be looking across all four of these numbers, thinking, you know, there's not a whole lot of difference between those numbers. Let's just take it at 62 and be done with it. And if you knew that was your life expectancy, you should do that. No, but you don't, right? Yeah. So what if we add 10 years to each of these life expectancies? What happens? Now, I should let you all know that I'm working on a patent for where I push a button, we just all live 10 years longer. It only works in PowerPoint right now. Okay, so here we go. You will notice that our hybrid strategy is still the winner. It's now getting them $1.05 million out of the system. But look what went from last place to almost first place, age 70. And look what's way in last place at this point, age 62, by about $200,000. So now here's the power of this analysis. You can take your unique situation, your primary insurance amounts, the life expectancies you want to look at, maybe the discrepancies in age that you have, right? I'm assuming they're both the same age in my example, but that's not going to be the case. And you can have this analysis run for you so that then you can have a conversation about, should we take it early? Should we wait? Should we maybe do a combination strategy? If you were this couple, you might decide, you know what, I realize we might be leaving $200,000 on the table, but we're okay with that. And we're going to both take it at 62. Or you might be, wow, $200,000 is a lot of money. Honey, you're going to wait till 70. Whatever you end up deciding, or one of you ends up deciding for both of you, you've now just made an informed decision about your benefit. You're not guessing, or worse, going off some rule of thumb that Susie Orman tossed out on the Today Show. This is your situation that you're able to analyze and understand why you might be taking it early and what you could be giving up for that, or why you're waiting and what that potential reward is. How many people in the room make $100,000 purchase decisions by just throwing a dart at the board? When we're talking about your money. I asked that question about 2 months ago, and somebody raised their hand. I'm like, really? He's like, well, yeah, when it's not my money, what do I care? And I said, all right, well, let me clarify my question then. When we're talking about your money, right, you don't. You do the research necessary to make sure you're making a good decision there. We're talking about hundreds of thousands of dollars here. I would encourage you to take advantage of that. All right, so we've gone through a scenario where we had a high earner and a low earner. Let me take you through a different scenario. But before I do that, this is a sample of the output you will get. Up at the top, we summarize all the benefits, spousal, survivor, your own, at various ages. We then give you an analysis for each life expectancy pair that you've selected. We show you the 4 collection decisions, 62, 66, 70, and then whatever combination strategy you want to look at with your advisor. And then we highlight whichever one gets you the most money. But then we also give you a graph that shows you how long does the last person living have to live for a given strategy to be better than one of the other ones. So for John and Jane with the 75 and 82, basically what this is telling us is that if Jane's only going to live till 78, they're better off both taking the money at 66. But as soon as Jane makes it to 81, any month past that, they were better off with the hybrid strategy. So it gives you a way of kind of just understanding how these things relate to one another, and also how much money we're talking about, right? If we look down at the bottom here and all these numbers are within $10,000 of one another, who cares? Take it at 62, right? There's not a big enough difference to worry about. But if it's $200,000, well, maybe that's something we need to talk about. So that's a sample of the output. Now, as I said, I wanted to go to a different situation. I'm now going to bump up Jane's primary insurance amount to $1,400. I'm doing that because it's larger than the spousal benefit. So for a couple like this, where their earnings histories are closer together, I would still suggest that the higher earner do the exact same thing we did before. File and suspend and ultimately take their money at 70. But now I'm going to suggest that that lower earner do something different. They shouldn't take their money right away. Instead, they should wait till their full retirement age, because at that point they're going to get a new option. And that's the option to pick and choose which money they want versus which money they don't want. One of the most common mistakes or misconceptions about this system that people have is that they get to choose which benefits they want whenever they want them. And that is not the case. If you call up Social Security prior to your full retirement age, you have to take your own benefit. And if you're eligible for the spousal benefit, you got to take that one too. All right? They don't give you the option to say, oh no, I'll just take the spousal benefit and then I'll take mine later. Or just give me mine, let me wait on that spousal benefit. Doesn't work that way. If you call up prior to your full retirement age, you got to take your own, and then if you're also eligible for that spousal, you have to take that one too. But at full retirement age, you do get to pick and choose. So in this case, Jane could either take $1,400 off her own earnings history or $1,100 off of his. Quick show of hands. Who thinks you should take the lower number? I never sell that one. Who thinks you should take the bigger number? Okay? Who's not going to raise your hand no matter what question I ask? The correct answer is both. The lower number. And the reason she needs to take the lower number is because that's the spousal benefit. That's the one that doesn't get any bigger. So she collects it for 4 years while her own benefit grows by 32%. And then she calls back at 70 and says, now I'll take my benefit. This is a really powerful strategy for two high earners who don't need the money. Because in this case, it was almost $300,000 better than both of them taking it at age 62. And it's even better than both of them waiting till 70, because in this scenario, they got 4 years of cash flow from that spousal benefit that otherwise, if they both waited till 70, they were leaving on the table. So food for thought, if you're in this situation or you know someone in this situation, because it can really be a powerful strategy for you. All right, last strategy I want to talk about today has to do with widows or widowers. You can collect a survivor benefit as early as age 60. You don't have to wait till 62 like you do with your own benefit or a spousal benefit. So in a case like Wendy's, where she had a pretty good earnings history and her deceased spouse had a pretty good earnings history, for Wendy, I would suggest she actually take that survivor benefit as soon as she can at age 60. One, because it's the only benefit she can take that early. She can't take her own. And once she gets this, the survivor benefit doesn't get any bigger after 66 either, like her own does. So she can collect that survivor benefit for 10 years, and then her own benefit keeps growing till 70. So while her own benefit started off as a smaller benefit, by the time it got that 32% increase, it was a bigger benefit, so she can then switch over to that one. So it's just understanding what you can and can't do, what benefits grow versus which ones don't, that can help you put a good strategy together when you talk with your financial advisor about your unique situation. All right, that's kind of the point I'm trying to make here. All right, and you'll see that obviously for Wendy that was a heck of a lot better than just taking her own money at 62. All right, I have one more slide I want to go over, and then because we're in the state of Colorado, we have an optional extra credit section. All right. This last slide I want to go over is my favorite slide in the whole presentation. The reason I love this slide so much is I'm pretty certain when I'm done with it, every single one of you is going to be able to call at least one person that you know and let them know about money they didn't know they were entitled to. And if you position that right, it's got to be good for at least a bottle of wine, if not a full dinner. All right, so let's put our thinking caps on and think about anybody that you know that meets the following 3 criteria. Criteria 1, the person you're thinking about who's married to somebody else for at least 10 years. Criteria 2, the person you're thinking about is currently unmarried. And criteria 3, both the person you're thinking about and their ex-spouse have obtained the age of 62. Anybody that comes to mind, you should call up and let them know they're entitled to a spousal benefit, based upon the entire earnings history of their ex-spouse. Not just the period of time they were married to them, but that ex-spouse's entire earnings history. And there is not a divorce decree on this planet that can prevent them from collecting that money. And once that ex-spouse passes away, as long as the person you're thinking about isn't the reason for their demise, Social Security does not send checks to penal institutions or sanitariums, all right? So as long as the person you're thinking about didn't have anything to do with it, or get caught, they would be entitled to a survivor benefit based upon the entire earnings history of that ex-spouse. Now, a few things you need to be aware of. Some of those strategies we talked about work for divorced people. So if the person you're thinking about was a high earner, and their ex-spouse was a high earner, you might suggest to them that they wait till their full retirement age. Take 50% of that ex-spouse's benefit for 4 years, while their own benefit grows by 32%, and then at 70, they switch over to their own benefit. They're going to be like, really? I can do that? And you're going to be like, yeah, really? Maybe we should talk about 2 bottles. Another thing you should be aware of. Regardless of the decision that the person you're thinking about makes, it will not have any impact whatsoever on the ex-spouse or any new spouses or ex-spouses they may have accumulated along the way. Actually, this person won't even know that the person you're thinking about is trying to benefit off their earnings history, because it's none of their business. The only way this person ever finds out is if the person you're thinking about writes them a little vindictive note, thanking them for all the extra income that they are now currently enjoying. All right? Last thing I want to say on this particular topic. Nobody in America is ever going to get the following letter from Social Security. Dear dummy, I got a whole pile of money I could be sending you if you just call me up and ask for it. Now again, it'd probably be worded a little nicer than that. And they might get one of those from their friend in Nigeria who just won the lottery. But Social Security isn't sending that letter out, right? The way the system works is you need to know you're entitled to the money and you need to call up and ask for it. It doesn't just magically show up in your mailbox one day. And this criteria I just went over, you will not find on the statement. There are a lot of people out there who have no idea they're eligible for this money, and it is your civic duty to let them know. But if you got a lot of people on the list, don't call them all up at once, because that's a lot of dinners back to back events. Okay, so spread those out. All right, now as I mentioned, because we're in the state of Colorado, you're eligible for extra credit. The reason is because any teacher in the state of Colorado pays into something called para, right? And while they're paying into para, they're not paying into Social Security. And anybody who is earning a benefit while not paying into Social Security is going to be subject to 2 things that we should cover. One is called the government pension offset, and one is called the windfall elimination provision. Okay? So just real quickly for extra credit, we're skipping all this boring stuff. And then compliance information that you're all reading right now. Thank you for reading. Oh, come on, you're all Evelyn's Wood students. You read that. All right. Government pension offset is really important. If Jane were a teacher in the state of Colorado, and she earned a $1,500 a month pension from that employment, she would discover that when she tries to go and collect a spousal or a survivor benefit off of her husband, that it's going to be reduced by a government pension offset. And that offset is equal to 2/3 of her teacher's pension, or $1,000. So remember that $1,100 spousal benefit? It's only going to be a $100 spousal benefit in her case. And if John decided to take his money at full retirement age and lock in a $2,200 a month survivor benefit, Jane will only receive a $1,200 a month survivor benefit. If this teacher's pension is $4,000, $5,000, or $6,000 a month, there is no spousal or survivor benefit that will survive that reduction. In that instance, that person should be thinking about their collection decision as if they were single. because there is no spousal, there is no survivor benefit to consider. So when you're putting together your phone list of people you're going to call to meet that criteria, you may want to cross off the teachers from the list. Because while they are eligible for a spousal benefit, it's going to be reduced, maybe to 0. Right? So, hey, good news, you're eligible for some money that because you're a teacher you can't have. Right? So maybe cross them off your call list. So that's government pension offset. It affects spousal and survivor benefits. Let's say Jane actually paid into Social Security for a while and was a teacher. So just for my illustration, we'll say she was a teacher for 10 years, and then she went to work for Lockheed Martin for 20, paying into Social Security. What she's going to discover is when she goes to collect her own benefit, she's impacted by something known as the Windfall elimination provision. Everybody remember at the beginning of this presentation where I said that the amount of money you're going to get is based upon your best 35 years of work history? Yeah. Well, there's actually a formula they use to come up with that. Now, for the engineers in the room, you might want to Google average index monthly earnings amount and just knock yourself out on the complexity of this calculation. But I'm just going to simplify it by pointing out this. This formula reflects the original purpose for which Social Security was created. It's to keep seniors out of poverty. So, the way it's structured, if you were a low earner, you get a higher percentage of your money back because you need it to stay out of poverty. The higher earner you become, the thought is the less money you're going to need back in order to stay out of poverty, as a percentage basis, right? So that's how the formula is structured. Well, what they didn't want to have happen is they didn't want to have someone look like a low earner, but they really weren't because they paid into this other system at the same time. So to eliminate that windfall, they changed that first percentage down to 40% for people affected by windfall elimination provision. Now, for every year that Jane pays into the system past 20, they change that percentage, then move it up by 5%. So if she pays into the system for 30 years, she has the same formula as everybody else. What I need to emphasize here is, while government pension offset can reduce a spousal and survivor benefit to 0, windfall elimination provision could not reduce your own benefit to 0. All right? You will, if you paid into the system for 10 years, you will get a benefit. But if you also paid into this other system, while not paying into Social Security, you're going to discover if you have the exact same work history as somebody else, you'll get less money than they will every month because of this. All right. Look, I've covered a lot of information here, I realize that. My goal was not to make any of you experts on Social Security. My goal was to sensitize you to the fact that you have options. And you should explore those options to arrive at the best possible decision for your unique circumstance. The reason I think this is so important today is that the likelihood of you getting quality advice out of Social Security is a lot lower than it was 10 years ago. 2 things have happened since then. 5 years ago, the first baby boomer turned 62. The call volume at Social Security went through the roof. Staffing has stayed the same or gone down. So they actually are being trained not to be as consultative as they might have been in the past because they don't want to keep somebody in the queue longer than they've already been in the queue. So they're really trained to just be order takers. Secondly, you really don't have any idea whether you're getting an expert or someone new to the system when you call up. So you could get bad advice, and you might not know it's bad advice. So it is in the best interest of all of you to research your decision before you call Social Security and figure out what you want to do and what's in your best interest so that when you are talking to them, you're placing your order. And you're being adamant about the order you want to place. You're not going to let them talk you out of it. You're not going to let them tell you you can't do it. Because that happens all the time. If you need to talk to a supervisor, you ask to talk to the supervisor. But that's probably the last advice I'll leave you with, is it is in your best interest to make sure you know what you want to do before you reach out to them. Okay? All right, so with that, we've got some time for questions. So I'm more than happy to take any question you have, except why the CU buffs are so horrible this year. I'm not fielding that. Yes?
If you decide to do the delayed retirement, do you need to call and tell them, or they just assume that if you don't call?
They just assume it if you don't call.
So you don't have to let them.
So you don't have to call them, right? And they're just going to pretend, I mean, if you never call them, you'll never get a check. So, but you want to call them before 70, or right at 70, because they don't get any bigger after that. Yeah, question here.
What about the fact that the pot is supposed to run dry?
Oh, good question. So, people have said the pot's supposed to run dry. That's somewhat of a misnomer, all right? The pot is, when we talk about the pot, meaning the money available to pay benefits, that pot never runs dry because every year new money flows into that pot. What we should be concerned with, though, is that over the last 20 years, a major surplus has been built up by all the baby boomers paying into the system and not enough other people taking that money out. So there's been a huge surplus that has been built up. If you're interested, it's actually sitting in a drawer in Pennsylvania in the form of $10 million IOUs. If you're curious. The estimate is that in the year 2033, that last IOU will be ripped out and there will be no more IOUs left. And so at that point, the system will have to survive on just incoming cash flow, which they are estimating in the year 23 will only be sufficient to pay about 75 cents of every dollar they owe. So if nothing changes between now and then, everyone should expect a 25% haircut to their benefit. Okay? Now, as a piece of context, the last time they overhauled this system in the early 80s, there were only 3 or 4 years left before they were going to have to do that same thing. Now, I'm hopeful that it will not take them another 16 or 17 years to figure out what they're going to do to shore up the system. But please, don't think you need to take your benefit right now because, you know, I need to get some while the getting's good. All right? The check won't bounce for another 20 years, right? At that point, that's when you're going to need to think about, you know, that reality. All right? What else can I answer for you? Yes, right here.
Did I understand you correctly that everybody should, even if you're going to wait till 70, you should, at your full retirement age, collect, or not collect, but
File.
and suspend?
99% of the time, yes. There are a couple of rare exceptions where you might not want to do that. One of them is if you're contributing to a health savings account. For whatever goofy reason, they have determined that once you file for your Social Security benefit, that disqualifies you from contributing to a health savings account. I have no idea why that is the case, but they have. It has something to do with Medicare eligibility as well, and I don't even pretend to understand all the complications around that, but that is one of the reasons why you may not want to file for your benefit. The other is, if you have a younger spouse who you want to implement a strategy where they take their money first, and then they take the spousal benefit at a later date, you don't want to file prior to them collecting their benefit. Because if you file first, when they then go to collect their benefit, they're going to have to take their benefit and the spousal benefit at that point because they're eligible for it. So there may be some timing there where you wait to file until the younger person collects their money, because they'll go to collect, they'll see, oh, you're only eligible for your own money, so we'll give you that check. The next day, the other person could file and suspend, making them eligible for it, but they won't automatically send them the spousal benefit. You have to call up and ask for it, so you could wait till your full retirement age to call up and ask for it. Those are the only two reasons I'm aware of why you wouldn't want to file and suspend if you're thinking of waiting. Health savings account, and if there's a strategy where you're wanting to not make your spouse eligible for that spousal benefit right away. Okay? All right, I had a question here. Yeah.
What if, on the single people, or someone who's been married before, not married now,
Yeah.
if they had been married to more than one person
Yeah.
for 10 years and divorced in 10 years and divorced
Yeah.
again,
Yeah.
can they get it off both people, or just one?
Right, so the question is, if you're married to more than one person for at least 10 year,s how does that work? And you don't get to collect off of all the people you were married to. You get to pick the better of those options. So I often will give the example of Johnny Carson and Larry King. So, yeah, it's a good example. So how many people in this room know how many spouses Johnny Carson had?
7?
No, I think it's 4. I think Larry King is at 7. I think 4. How many of those qualified for a benefit off of Johnny Carson's earning record? 3. 3 of them did. One of them was only married for 9 years and 6 months. Right? Before you, that was all right. They got a pretty hefty settlement. But while Johnny was alive, all 3 of them could claim a benefit off of his earnings record. And he had the choice of which one of those, if he was divorced. Actually, I think he was married to the last one when he died, so he'd have to take the spousal off of them. But all the other 3 could take a spousal benefit off of him. They had no impact on one another. And then when he passes away, those 3 surviving spouses could all collect a survivor benefit off of his earnings record, and they wouldn't have an impact on one another. Larry King, how many people can collect off of Larry King's earnings history? 1, Larry King. Nobody was married to him for more than 10 years. One. So, that's how that works, right? So, all right, what else? We had some, yes?
How would you factor quality of life into some of these decisions? Because if I had a pot of money at 62, but I had a bigger pot at 82, what would I do with all that money at 82? I'd rather have it at 62 and have fun.
Right, so the question was, doesn't there need to be a quality of life consideration to this decision, right? Like, so what good does it do to save up this really big check if I'm not able to enjoy it when it's coming in? I would actually frame that question a little bit differently. That question is about how do you structure the cash flow plan in retirement that's going to make sense for you, regardless of the source, whether you're taking that from Social Security or assets or a pension or an annuity, right? Fundamentally, you need to decide with your financial advisor, do I want to spend a lot of money up front and a little bit at the end, a lot and a lot, little and a little? And that should be outside the decision for Social Security, because Social Security is just another pot of money that you're going to use to fund that cash flow you've laid out. And what we're showing here is there's a way to increase the size of Social Security's contribution to that pot of money. There's also some tax issues you should be thinking about and other things. But I wouldn't use quality of life as the factor to apply to the Social Security decision, because it really should be applied to the larger retirement income decision. Okay? Yeah, question here.
Yeah, the Social Security Benefits Estimator, is this a app that we can use, or we would go through Steve?
So you have to go through Steve or one of the advisors in this room. We make that calculator, that estimator available to our partners. So you have to reach out to them in order to have it run. And you'll have to bring 2 primary insurance amounts, and you'll need to talk life expectancy assumptions. Okay? Way in the back in the cheap seats.
We have a friend whose husband passed away, and she now collects her Social Security plus his. And,
They're going to catch up to her.
well, yeah, we told her that that was illegal. She claims that she calls Social Security and they insist that they're right.
So, again, you're only able to claim either or. It would not be the first time, nor will it be the last time that Social Security makes a mistake. And the thing I would just caution her is, there is the potential at some point in the future that someone different at Social Security takes a look at it and goes, ooh, you owe us, and they're going to multiply all of the lower check that they've been sending times the amount of time they've sent it and demand that she pay it back, or withhold it from her survivor benefit going forward, which would be really all horrible. So I just make sure you caution her about that.
You tell her, she won't listen to us.
Yes.
Are spousal benefits available to everyone regardless of income?
Yes, there is no means test associated with any Social Security benefit. So it doesn't matter how much money you make. Now, clearly, I did explain that withholdings test thing, right? So if you're trying to collect a spousal benefit, a survivor benefit, or your own benefit prior to your full retirement age, it does matter how much money you're making, right? There is that withholdings test. But in general, with regards to eligibility for benefits, there is no income test with regards to whether or not you're eligible to receive money. Does that answer your question?
Yes.
Okay. Yes?
And the example you gave of the divorced collect survivor benefit, or not survivor, but spousal benefit for
Yeah.
the divorced
Take
person.
50% for 4 years and then switch to your own
No,
at 70?
the age 62 were married at least 10 years, and now they're,
Oh, just that you're eligible for the
yeah.
money. Right, not the strategy.
Does the primary wage earner have to be age 66?
Oh, okay, good question. So no, I think what you're getting at is there's a difference between criteria for being eligible for a spousal benefit when you're still married to someone versus the criteria used in the case of divorce.
Right.
When you are married to someone, whoever you want to collect a spousal benefit off of, that person needs to file for their own benefit first. You are not eligible for the spousal benefit until they at least file. In the case of divorce, the only criteria is you both have achieved the age of 62. It doesn't matter if they file at 62, they just have to turn 62. And at that point, you are eligible. Now I need to remind you that just because you're eligible at 62 to collect it, doesn't mean that's what you want to do. Because let me remind you, at 62, you're going to have to take your own money as well. You don't get to pass on that and say, oh, let me just take that spousal for a while, and then I'll go to mine. It doesn't work that way. prior to your full retirement age, you have to take your own, and then if there is a spousal available, you can, and it's bigger, you can have some of that as well, but there's no picking and choosing prior to full retirement age.
I see.
Okay. All right, were there any other hands? Did I get them all?
How would Social Security know if someone was divorced?
So, the way that you prove your eligibility for a benefit based upon someone you used to be married is you will need to show Social Security a marriage certificate and a divorce decree. Those are the two documents that they will require. And from that, they will be able, you don't need to bring them your ex-spouse's Social Security number. You just need those two documents. They'll figure it out from there.
So you give how many presentations like this a year?
A lot.
So out of a lot, what are some of the most obscure questions that have been asked that would be appropriate for this group?
Now that good qualifier, because I've had some really obscure ones that I would always. So here's one that I'll often get in various flavors, which is, so I'm collecting my benefit at 66, 67, and I'm still working, paying into the system. Do I get credit for that? And the answer is yes, you do, actually. Social Security will recalculate your primary insurance amount every year. So if at age 67 you just worked a better year than one of your previous 35, next year your check will go up. And if there's a spousal benefit being collected, that'll go up as well because your primary insurance amount went up. So that's something that people often ask about. What else do I get that we haven't covered at this point?
When do you think they'll change the formula, the eligibility age formula? I mean, what is your best guess? Because it's all math.
All right, so let me just be really clear. My crystal ball is as cloudy as anybody else's with what Congress is going to do with this program, right? I think that going back to the whole comment around, isn't this thing running out of money? Clearly they are talking and have been talking about changes that need to be made. And if you look at all the things they've evaluated, one of the logical candidates is moving that full retirement age out again. They did it in the 80s, right? But they did it well enough in advance so that anybody impacted was like, oh, who cares? That's like 20 years in the future, fine. They could do the same thing, because when you think about it, when this system was put in place, what was the average life expectancy?
75?
Yeah, it was like 70 something, right? It was like 10 years you were expected to be collecting a Social Security benefit. They moved it out once, 2 years. Life expectancy's gone out about 10 since then. So that's a logical place, but I can't vouch for the logical behavior of Congress, right? I don't know when they're going to get at it and whether they'll pick that. Another thing to think about is any money you make over around $113,000, $115,000, it goes up every year. You're not paying Social Security payroll tax on. Right? They changed that for Medicare in the early 90s. They took that cap off. So now no matter how much money you earn, you're paying 1.45% into Medicare, and your employer's paying 1.45% into Medicare. Past that 113 or 115, I can't remember what the limit is right now, you're not for Social Security. They could change that, right? They could move it up, they could get rid of it. I actually read somewhere that if they got rid of it entirely, that would sustain Social Security for like another 70 years. So they have a lot of levers that they can pull to try and shore up this system. The question that I don't know anybody has a good answer for is which ones they're going to pull and when they're going to pull it. Right? The other one that comes up is a notion of a means test, right? So if you make too much money, you get less. They actually implemented a means test back in the 80s when they actually applied taxation to Social Security. So prior to early 80s, you actually got all your Social Security and you never paid any federal income tax on it. Then in the 80s, they're like, hey, wait a minute, here's another way how we can help the system. We will subject part or up to 85% of your benefit to federal income tax. So right now, that cap is at 85%. No matter how much money you make, you get to keep at least 15% of your Social Security tax-free. They could get rid of that. That would be another way of kind of expanding the means test. They could change the way it's applied within taxation. So they have other levers there that they can pull. I found it fascinating that in President Obama's budget this year, the lever he tried to pull was changing the math used to calculate the cost of living adjustment. So every year, all Social Security benefits go up by whatever the cost of living adjustment is. And despite some people's belief that there's some people in a room deciding, hey, should we really stick with the seniors this year, or should we give them a big raise? That's not happening, right? There's actually a formula. They look at the CPI for the preceding 12 months, and whatever that was, essentially that's what the raise is. I do find it fascinating, though, that the announcement for this year's cost of living adjustment was delayed by 15 days because the government was shut down. And the Department of Labor wasn't producing those statistics, so they couldn't come out with the numbers, so they had to wait 2 more weeks to find out what it would be. But all benefits get that cost of living adjustment. And President Obama's suggestion was, well, let's change the way that's done so that we just lower the trajectory of that increase, and that'll help shore up the system. I don't know if that's all that. I mean, that's basically just saying, let's just cut everybody's benefit by a certain percentage, because fundamentally that's what it's going to do. So anyway, I probably spent way too much time on that particular question. Yes?
Do you have a good ballpark idea of how much, say you're 60, 61, you quit taking the salary versus how much that would affect?
Oh, that's a great question. So the question is, hey, I'm getting to a point where I can decide whether I'm, going to keep the pedal to the metal and earn a lot, or I can scale back a little bit. I'm a little concerned about how that's going to affect my Social Security benefit, right? Social Security actually has a pretty good calculator on their website to help you with that particular question. It's called the Retirement Estimator. So if you go to the website, ssa.gov, and you look in the left-hand menu for something called the Retirement Estimator, if you click on that, they're going to ask you some personal information, social, I think it's date of birth, state you were born in, and mother's maiden name, I think the 4 things they ask. They will at that point query your best 35 years of work history in real time and produce 62, 66, and 70 estimates. And at the bottom of that screen, there will be a field for earnings assumption going forward. You could change that to 0 and see what would your check look like if you stopped working today. How much would you get at 62, 66, and 70? Or cut that number in half, right? So I earn half as much as I've been earning. You'll see what the numbers look like. Or double it, right? See what the numbers. So it can be really helpful in understanding, am I going to see a $15 a month change or a $250 a month change? All right? Yes?
In reviewing your earnings records, you mentioned that if you have like 3 years and 15 days to correct it.
You have 3 years, 3 months, and 15 days.
So if you find an error from 10 years ago?
You should still call up and try and get it fixed, because they do have a bunch of exceptions to that particular rule. But you may find that at first glance they're like, sorry, tough luck, you didn't call us in time.
I see.
My advice to anybody who gets an answer from Social Security they don't like, ask again. Well, no, actually, well, yeah, you can go back and get a different person. But the other thing is you can appeal that decision. They have a very exhaustive appeals process that I actually am of the opinion they probably have an infinite level to that appeals process. But you should. If you think that they gave you an answer that doesn't make sense, you should appeal that decision. Okay?
Thank you.
You're welcome. All right. Have we run out of energy?
One last question.
All right.
So I asked about the most common, or a question that would be common to this group. To go out on a light note, what's the wildest question, or the wildest situation that you've heard from our United States of America?
Oh.
Even mine were all adult.
Yeah. No, well, all right. You know what? Instead, yeah, being recorded. So let me just offer this instead. Let me offer an observation about having given this presentation all over the country. And the observation is this. When I'm in California delivering this presentation, I rarely make it off the 3rd slide before somebody's hand goes up and asks me, now what about divorce? When I'm in the Deep South, I never get the question. And here in the middle of the country, usually we're either right at the slide or just before it, before that question pops up. So, not attempting to make any judgments about that particular observation, but just thought you might find that interesting.
Well, thank you very much, Rob. We really appreciate your investing the time. We appreciate BlackRock, which, by the way, I'm supposed to tell the attorneys to make the attorneys happy. Rob nor BlackRock are affiliated with LPL, nor are they affiliated with Prosperion, so we can mark that off our compliance report. And just if any of you have questions, if you'd like to see some of the scenarios, just contact your advisor. and we're happy to share with you the resources that we have with BlackRock. We appreciate what you folks do for us, Rob and Tom, and we especially appreciate you as clients. And we're here to serve you, help you make really wonderful decisions with your capital. So thank you very much.